Let us move to the last reading of study session 14, reading 51, which is equity valuation, concept and basic tools. Under this LOS, we are going to look at security valuation and the various valuation models for equity. Then we'll also look at the intrinsic value for a non-callable, non-convertible preferred stock. For equity valuation, we will look at Gordon growth model, multi-stage model. Then we'll look at the companies that use different growth models. We'll also understand the multiples based on fundamentals and comparables, for example, price to book value or price to earning, etc. These are the price multiples. We'll also understand the enterprise value multiple, then asset-based models, and finally, the advantages and disadvantages of various valuation models. So let us start with the concept of security valuation. The primary objective behind security valuation is to understand whether the market price of the security is more or less than the intrinsic value, whether the security is overpriced or underpriced. So if analysts find a security underpriced, then he can give a buy recommendation, or if it is overpriced, then it should be sold. So that conclusion can be drawn after security valuation. So once the analyst finds a security overvalued, undervalued or fairly valued, in first two cases abnormal profits can be made only when the analyst is sure that the stock's market price will eventually move towards its intrinsic value. There could be cases where the intrinsic value is different from the market price, but the market price is not converging to the intrinsic value. In that case, the analyst will not be able to make any profit. So these things should be considered while making such a decision. First is percentage difference between market prices and estimated prices. There has to be a significant difference so that analyst can take advantage of mispricing. Second is how confident is the investor about the appropriate of the valuation model. If the investor is fully confident that the valuation model which he or she has used is most appropriate one, then the valuation is more reliable and the intrinsic value based on that will be more accurate. So a decision can be made. Third is how confident is the investor about the inputs used in the model. So all the inputs should be reliable. Fourth is an investor must consider why stock is mispriced. So once the mispricing has been found, there has to be proper rationale for that. If the investor is not able to find the appropriate reason of mispricing, then valuation model may be incorrect. And finally, the time horizon in which the stock's market price is expected to move towards intrinsic value should be in sync with the investor's expectation. Suppose investor expects that within a month the market price will converge towards intrinsic value, then he can take a position for a month. Now let us look at various valuation models. The most commonly used models are discounted cash flow models, where the future cash flows from the equity are estimated and then they are discounted to present value. So there could be two models. First is where we are calculating the present value of cash distributed to stockholders. For example, dividend discount model. Another way of looking at it is when we are calculating the present value of cash available to stockholders after meeting all the necessary capital requirement. So after we have already met capital requirements, we have free cash flows to equity. So this free cash flow to the equity at different time intervals has to be discounted to present value, and some of that will give us intrinsic value of the share. Another kinds of models are multiplier models, where we look at the multiple. For example, the price model, where we have the price of the stock which is given by the market and the fundamental values, for example book value, sales, earnings, etc. So we can have price to book value, price to sales or price to earning ratio, and then we can do a comparative analysis within one industry or one category and find out which of the stocks are overvalued and which are undervalued. Another similar mechanism is enterprise value. So we can use ratio of enterprise value to revenue or EBITDA, etc. And through comparative analysis, we can find out the right valuation of the security. This enterprise value is nothing but the market value of the firm's outstanding shares minus cash and short-term investment. So this is how we calculate enterprise value. The another kind of models are asset-based models, where we look at total assets, less liabilities, less preferred stock. So whatever is left, that belong to the equity shareholders. So we can value that, and these assets will give us some idea about the value of the company. So this book value of assets and liabilities are to be adjusted to the fair value. So analyst will adjust it to the fair value and estimate the market value of the equity. Now let us look at the individual models. First model is dividend discount model. So this is a discounted cash flow based model where we have future dividends and future price from which we can calculate the value of a company or a stock. So this value of the stock is the amount which investor is investing in the company, and dividends is the return which he expects in the future. First let us look at the simplest case of dividend discount model, where we are using 1 year dividend discount model, in which the holding period of an investor is just 1 year. So we know the current stock price, then the expected dividend at the end of the year is known, and the expected price at the end of the period is known, and finally the required rate of return is known. So these are the values of dividend and price. So this is the return, this is dividend return, this is capital return after 1 year discounted at today's price. So this should be the current price. So if the value of the share is more than the actual current price, then it is overvalued. It will be undervalued. If the price is less than the value, then it is undervalued. If price is more than the value, then it is overvalued. So using this formula, we can easily calculate the value of the share. Let us take an example. Assuming that stock paid $5 dividend last year, and next year dividend is expected to be 10% higher than that. At the end of the year, the stock will sell for $105. The investor has a required rate of return of 15%. So we need to find out the current value of the share so that we can compare it with the market price and take a decision of buying or selling. So next year's dividend is going to be, which is represented by D1, D0 into 1 plus growth rate. We already know that dividend is going to be 10% higher than the last year's dividend, which was $5. So the next year's dividend is $5.5. Now D1 is known, 5.5. The price at the end of next year is already known, which is 105. The expected rate of return is 15%. So we already know the value, D1 plus P1 divided by 1 plus R. So we have, this is D1, P1, this is value of R. So we can calculate these two values. It is $96.08. So if the price is greater than V0, suppose price is $100, then we can say it is overpriced. We should sell the stock. And if we find that P0 is less than V0, or for example $95, if the price is $95, then it is underpriced and we should buy the stock. So this is how we make a decision based on equity valuation. Let us move to the next slide. So far we have seen the dividend discount model where the holding period was 1 year. Let us look at the case where there are multiple holding year. So if the investor wants to hold the security for more than 1 year, then we can use this model. The only difference is we can have different dividends which are expected for all the years, and we are discounting them to present value. And finally, the price after the holding period. Let us take up an example of this. Suppose the stock paid $5 last year. Next year's dividend is going to be 10% higher. The investor plans to sell the stock for $110 after 2 years. So the holding period is 2 years and the price at the end of it is 110. The required rate of return is given to be 15%. So let us find out what is the dividend next year. It will be $5 into 1.1. 10% higher is $5.5. We are assuming that it is going to rise by 10% again in the next year. So dividend for second year is going to be 10% higher than 5.5, which is 6.05. Now we have D1, D2 and final price, which is P2, given to be $110. So we can find out the value. So what is the payment at the end of first year? D1 divided by 1.15. So this was the first year's discount. Then at the end of second year we get D2, dividend of second year, plus P2, the final price at the end of second year. Then that should be discounted to current value. So 15% is the rate of return. So it is 1.15 square. So this is how we can find out the current value of the stock. So this is D1, this is D2 and this is P2. So we are discounting them appropriately and we get the value of $92.52. This is the value of the stock, and then we can compare it with the current price and then we can make a decision whether security is overvalued, undervalued or fairly valued. So this was about the dividend discount model. Another cash flow based model is free cash flow based model. So we can find out what is free cash flow available to the equity, which measures the cash which remains with the stockholders after the firm has fulfilled its debt obligation and operating expenses. So once the company has already paid for the interest, debt, etc., whatever amount is left with the equity shareholders, it is free cash flow. So we can find out free cash flow as cash flow from operating activities minus any investment which has to be made, capital investment, capital expansion, plus net borrowing if there is any borrowing involved. So this is the free cash flow available to equity shareholders. So we have this free cash flow for all the years that can be discounted to present value, and sum of those present values is the value of the equity. So based on projections, we can have cash flow from operating activities for all the next year. We can have expansion plans for next year, and then we can have borrowing plans. So that can be estimated, and FCFE for all those years can be calculated, and then we can discount it to the present value, sum of which is the value of the company. Let us take an example. So unlevered net income is given to be $5.2 for now. For first year it is 8.45, second year it is 12.35 and so on. So this is based on our estimates of say net sales and operating margin, etc. Then we calculate the tax and interest. We add the depreciation in order to find out the cash flow from operating activities. Then we subtract net capital expansion for all these years and change in net working capital. Then we add net borrowings, and finally we get free cash flow to equity. So for all these years we are going to have this free cash flow to equity, and then we can discount it at cost of equity. So our answer is going to be 5.72 plus 9.09 divided by 1.12 plus 11.31 divided by 1.12 square, since it was the end of second year, plus 13.43 divided by 1.12 cube, and so on. So all these values are to be discounted in order to achieve the value of the stock. So this was free cash flow to equity based dividend discount model. Discount model. So if we calculate, we get $52.1 million. This is the total free cash flow to the equity, or if we divide it by number of shareholders, we get price of the share or value of per share. Let us move to the next concept. which is the valuation of a preferred stock, which is non-callable and non-convertible. So it is simple preferred stock. There are no complications of call option and convertible option available with that. So for simple preferred stock, the holder is contractually paid a fixed dividend until expiration. So it will be same as perpetuity. Fixed amount of dividend is to be paid for unlimited amount of time. We have expected cost of capital. We can calculate the value of one preferred stock. Same as we calculate the value of perpetuity. Let us take a numerical example. So there is a preferred share that pays 5.7% dividend on par value of $100. If the investor's required rate of return is 8%, what would be the price? So we know that dividend payment is calculated on the par value. 5.75% of 100 is going to be $5.75 divided by required rate of return, which is 8% in this case. So we divide by 0.08 in order to achieve the value. So this is the value of the stock. Ideally this should be the price. If it is more or less, then we can take a decision of buying and selling based on whether the preferred stock is overpriced or underpriced. Let us move to the next slide. Gordon growth model. Gordon growth model is also known as constant growth model, since we are assuming that dividend is going to grow at a constant rate. So it is assumed that it is going to grow with that rate forever. Other assumption is that required rate of return is greater than the dividend rate. So these assumptions need to be met for this model to work. We can calculate the value as d naught into 1 plus g, where g is the growth of the dividend. So it is going to grow at this rate perpetually, divided by r minus g, where r is the required rate of return and g is growth rate of dividend. We know that d naught into 1 plus g is nothing but the dividend of next year. So formula becomes d1 divided by r minus g. So let us take a numerical example here. Suppose for a stock, dividend was $3 last year, and the dividends are expected to grow at 10% forever. The required rate of return is 13%. So we know last year's dividend was 3. So next year's dividend is going to be 3 into 1 plus g, which is 10%. So 1 plus 0.1. This is d1 divided by r minus g. R is 13% and g is 10%. So it is going to be 3 into 1.1, which is 3.3 divided by 0.03. So it is equal to $110. So we have made an assumption that R, required rate of return, is always greater than K. Otherwise the value will be negative. So this is the growth rate. So required rate of return is always greater than dividend growth. So we can find out the stock value. Now let us see how do we find out return and growth rate of dividend. So we have already seen in the Gordon growth model that in the denominator we have Ke minus G or R minus G, where K is the required rate of return on equity and G is dividend growth model. So smaller is the denominator, higher is the value. So the closer these values are going to be to each other, the higher is the value of the stock. Or we can say as the gap between KE and GC widens, the value of stock falls, and if the gap between them is narrowing, then the value of stock rises. And since these numbers are very small, they are in percentages, small change in them can cause large changes in the stock's price. And this growth rate of dividend can be calculated as retention rate into return on equity. As we already know that retention rate is 1 minus dividend payout ratio. This is the percentage of the return which is kept with the company for further investment. So the more amount company is going to keep with it for further investment, higher is going to be the growth rate of the dividend. Let us take an extreme case. If the company is paying all the money in the dividend. So dividend payout ratio is going to be 1 and retention rate will be 0. As an outcome, growth rate is going to be 0. In other words, we can say if the company is not retaining any profit with itself and is paying all the profit to the shareholders in the form of dividend, the growth rate of dividend is going to be 0. So dividend for next year is going to be the same as previous year. Let us take a numerical example here. Suppose a company is expected to pay dividends equal to 28% of the earnings. Return on equity is 22% and we need to find what is the sustainable growth rate of the dividend. As we know, G is retention rate into return on equity. And the retention rate is 1 minus dividend payout ratio. So if the dividend payment is 28% of earning, required rate is 1 minus 0.28, which is 0.72, into return on equity, which is given to be 22%, so 0.22, that will give us 0.1584. So it is 15.84%. That is our growth rate of dividend. Let us move to the next concept, the multi-stage model.